What if I told you you could be making money in your portfolio and still be falling behind? Hi, I am Karim Visram, Senior Portfolio Manager at RBC Dominion Securities. Welcome back to another episode of Deeper Dive, where we unpack financial topics that matter the most to you. Today is May the 14th, 2026, and we are tackling something that affects every investor: inflation. You have likely heard of the term invisible tax, and for good reasons. Inflation quietly erodes purchasing power and can significantly impact your investment returns. With energy prices on the rise, inflation is expected to remain elevated in the months ahead, making it important than ever to ensure your investment strategies account for these dynamics. So here is what we will explore today in about 10 to 15 minutes. Practical strategies to help protect your investment against inflationary pressures, and more importantly, which asset classes approaches can actually make you money in today's environment. I am genuinely excited to introduce our special guest today, Richard Tan. Richard is a portfolio manager with our portfolio advisory group. Richard and his team have done some outstanding research recently on how inflation impacts your investment performance, and critically, which strategies and assets can serve in protecting your portfolio. Richard, thank you for taking the time to join me in this another episode of Deeper Dive. Welcome. Thank you.
Perfect. Thanks, Karim. Happy to be here, and heard great things about this podcast that you've been doing. So it's a pleasure to be here on your show.
Thank you, Richard. Thank you. I would love you to take a deeper dive into your recent publication report that you entitled "Inflation: A Silent Erosion." What do you mean by that, and why should investors care about inflation right now, especially given the current market uncertainties?
Yeah. I think it's a very important topic here. So we take a little bit of a step back. It feels like we've crammed in about 2 or 3 years worth of economic events into the first 4 or 5 months of the year here. I mean, you had the continuation of the AI disruption threats. You had the challenges within the private markets that created a little bit more volatility with the markets as well. And then obviously you had a big uptick in geopolitics, notably within the Middle East. So with all this uncertainty that's floating around in the markets, we as humans, we at times get a little bit more emotional, and we think to ourselves, what, I've made a lot of money over the last couple of years. Equity markets have been very kind to me, and maybe I should take some money off the table, just given that, there's a lot of moving parts these days. And what I would note here is that, raising cash can work at times when you want to be tactical, but holding cash for elongated periods of time, there's dangers in that as well. So what I really mean by this is really talking about inflation. So if you look at the Canadian headline inflation over the last 20 years, on average per annum, it's averaged about 2.2%. Coming out of COVID, you saw that really big spike up in inflation. How do we get that big spike up? A lot of that was driven by the billions of dollars of fiscal stimulus. Global governments injected billions of dollars into the economy to support local businesses, consumers. Interest rates were basically near all-time lows. And then those of us that are so fortunate to be working from the comfort of our own homes, quite honestly, we didn't really have anywhere to spend it. So when global governments told us that we are now safe enough to go out and venture out, we said, you know what, I'm going to go out, I'm going to live my life again, and inflation went through the roof. But again, over the last 20 years, inflation has averaged about 2.2%. So put differently, every single year where you're not investing your capital, you're not putting that money to work, technically your purchasing power is eroding by roughly 2%. Hence the title, the silent erosion there.
Yeah. So this is great research. Richard, that you mentioned over the last 2 decades, inflation is hovered around 2.2% or whatever, right? Sometimes it's much higher, as you said, post-COVID and pre-COVID, inflation was much lower. But right now, with the with the advent of AI, the topic of the day right now, all the geopolitical uncertainty happening right now, what concerns you the most, or what excites you the most right now in current environment?
Yeah, I would say that the number one item that probably concerns me the most is the concept of stagflation. So what I mean by that is the environment where inflation starts to reaccelerate while simultaneously economic growth starts to slow. And the reason this is problematic is because if you think about the role of a central bank, their job there is to create economic stability to control inflation as well. So if inflation starts to spike towards the upside again, one of the tools that central banks have to use is monetary policy. So theoretically, they could increase interest rates to try to curb off inflation, but at the same time, they would be sacrificing some economic growth. On the flip side, if they were to decrease interest rates to try to stimulate economic growth, that does very little to solve the rising inflationary threats. So, as relates to the stock market, this is typically a suboptimal type of scenario because you probably are going to have some revenue growth, but a lot of that's going to be inflationary in nature. And then at the same time, when you think about your margins might actually compress as well. All else equal, your profits might actually shrink. To answer the latter part of your question, I wouldn't say that there's a scenario that necessarily excites me. So far, corporate earnings have been very robust, but if if I could choose an idealistic scenario, I would say if we'd have inflation somewhere between 1 to 3% per annum, very modest inflation, plus, normalized to above average GDP, that tends to be a better environment for stocks and risk on assets.
Now, Richard, you mentioned a word that scares me and probably scares a lot of us. Stagflation. Right? Last time we had stagflation was back in the 70s, and that was not a pleasant environment for more a lot of the investors right now. And with all the geopolitical uncertainty happening, inflation happening, many clients sometimes or many investors are thinking about holding cash, just keeping their money in cash. What would you say? What's the opportunity cost? That people sometimes don't take into account opportunity cost of just holding cash as opposed to having invested. What would your thoughts be on that?
Yeah, yeah, 100%. And I think framing the opportunity cost for everything is always important because we as investors, we're always trying to put the capital to best use. So let's walk through a hypothetical example here. Again, going back over the last 20 years, let's just assume for a second that we had $100 towards our name back in 2005.
Hmm.
Now, back in 2005, if you want to maintain the purchasing power of that $100 over the course of the next 20 years, so from 2005 through the end of 2025, you would have to turn that $100 into $153, i.e., that's basically the equivalent of a 53% return over the last 2 decades. Now, that again is just to maintain your level of purchasing power. Had you kept that $100 all in cash, what would have happened is that your purchasing power would have actually eroded by roughly 63%. Now, conversely, had you just been invested virtually into any other asset class out there, whether it was Canadian bonds, real estate, the equities, whether it's within Canada or the US markets, not only would you have protected your purchasing power, in fact, you actually would have expanded upon your purchasing power. Your purchasing power would have actually grown somewhere between the tune of about 20% to 300% over the last 2 decades.
Okay. So in a way, if I'm just looking at this chart here, that the work that you and your team have done here, over that time period, the 20 odd year, you almost better off doing anything other than just hold cash. Whether you invested in real estate or bonds or stocks, other than just holding cash or digging a hole in your backyard and putting money there, you were better off doing almost anything you know, um, other than just hold cash, because holding cash, as your research shows here, people are losing purchasing power. You almost need to have, almost, as I say, or more than, 50% more in cash just to maintain purchasing power. So you've gone from $100 to $150 to just maintain that purchasing power, right? So you're better off doing almost anything than just keep money in the bank. Would that make
100%.
sense?
Yeah, 100%. You always want your money to be working for you so that you can maintain your standard of living. Because every single year, when if you're not invested, the reality is that inflation is going to creep up, and therefore, it's going to be that much harder to maintain the lifestyle that you actually want.
Right, right, right. Now, one other thing I take from from this, that any one particular investment has done well, but they are volatile, right? So we see some volatility in anything, just stocks or real estate or bonds. So having a mixture of these investments, have a well diversified portfolio, will provide you with a better return, and less volatility, basically, right? Smooths out the return. If you have a mixture of stocks, bonds, Canadian stocks, US stocks, having a balanced portfolio as opposed to any one asset. Would that sound reasonable to you?
Yeah, I mean, like there's definitely benefits towards diversification, of course. Um, Everyone's financial profile is definitely a little bit more different.
Different. Yeah.
I would say that typically as a rule of thumb, the younger you are, the longer your time horizon, the more risk that you can afford to take within your own respective portfolios. I
Right.
myself, I'm a little bit biased because I look at equities for a living.
Hmm.
I'm not a fixed income investor. I like equities because,
Hmm.
these are companies that have the ability to participate in the longer term earnings growth of their respective companies, the longer term earnings growth of the broader economy as well. Whereas when you invest into bonds, there theoretically is more of an upside there because eventually when they mature, you just get paid back your principal plus the accrued interest. But even where every client's financial profile is, it makes sense to have a mix of both stocks and bonds, but that's why, we have advisors like yourself where you go through that discovery process with the clients, you learn about their individual financial needs, and you craft up that tailor-made portfolios for them and their lifestyles.
Right, right, right. Yeah, and that's why you need a balanced portfolio. If you look at this chart and said, "Hey, S&P 500 is on the best, best over that time period," investing 100% in that will give you the best return, but also it may take you for a big ride, and just like we saw during COVID time, had a big drop. So having a diversified portfolio, makes the most sense. Richard, in your research you've done, over the great research that you've done, if you could go back 20 years ago in 2005 and we were to give the younger Richard advice, from what you know today, what would that advice be to a younger Richard in 2005?
Yeah, I mean, if we could all turn back time, I'd probably be a richer man for sure. I probably have a lot of life secrets I could share to with everyone in the world. Probably pick a couple good lottery tickets as well.
Hmm.
But for the time
Me
being,
too.
if I could go back there, I just honestly, I stick with the basics. It's nothing phenomenal, but build a financial plan, stick to that plan, invest early, invest regularly, invest into a basket of securities. We just talked about the benefits of diversification. I myself, I prefer to own a basket of high quality stocks. What does high quality mean? And to me, it means a business with stable to grow earnings, sticky client base, margins are above that of other businesses out there. A very clean balance sheet, which means that when you go through an economic cycle, you're gonna have good times, you're gonna have not so good times. During the not so good times, you want to make sure that the balance sheet is strong enough that the company can actually weather through the storm. And then on top of that, ideally buy companies where you're not paying an arm and a leg for the valuation. Ideally, what we want to do is want to pay for good businesses at fair to attractive valuation. And I guess to top it all off, rebalance once in a while. Uh, we want to let our winners run, but at the same time, you want to make sure that you are adjusting the risk within your portfolio. So rebalancing is also quite key.
Yeah, yeah. No, I think rebalance is very, very important. We had done another deeper dive episode on basically rebalancing with one of your colleagues, and we talked about the importance of rebalancing and what rebalancing does, whether you rebalance once a year or as we do twice a year. So the aspect of rebalancing your portfolio regularly, at the very least once a year, is significantly important in portfolio management. As we say, Richard, if there is, in today's presentation and your research, great research you and your team have done, if there's one key takeaway, from this and everything, for our audience or whatever, one key lesson, what would that be?
I think if I had to pick just one key takeaway here, Karim, it would be understanding the key differences between nominal returns and real returns. So when clients look at their statements, on an annualized basis, they might say, "Oh, you know what? I'm up 10% this year." That sounds like a great return. The reality is that it's always going to be relative, because if I tell you that your portfolio was up 10%, but let's say for hypothetical scenarios, inflation was actually up 11%. Technically, on a real return basis, you would have actually lost 1%. So again, your purchasing power would have declined year over year. Conversely, let's say that your real return was, or let's say your nominal return here was 6%, and the rate of inflation was 3%. So now your real return actually would have been 3%. So year over year, not only again would you have maintained your purchasing power, but you would have actually grown it. So I think understanding the difference between nominal and real return, that's probably the key takeaway here.
Yeah, no, yeah, excellent, excellent. I guess for one key takeaway for me would be, managing one's own risk tolerance. From your research that I'm looking at, just the chart we're looking at right now, someone would say, hey, keeping in cash is the safest thing, but you're losing purchasing power. That's a risk itself, and that one has to quantify. There's a risk of falling behind just holding cash. Yes, you may have to take a bit more risk going into bonds or stocks, even U.S. stocks, and one has to look at their own risk tolerance. What's your risk? What's one's risk tolerance to how they want to invest? There's no free lunch, so one has to take some risk to get a better return. Is everyone has to evaluate what's their own personal risk tolerance and invest accordingly. And this risk tolerance could and generally does change with time as life evolves. So everyone has to be comfortable with that risk tolerance they're taking. Now, Richard, one last thing, on the fund side of, we talked about all the investment and all the important things. Now, on the fund side of the discussion, summer is around the corner. We hope, even though it doesn't look like summer is going to come. I got an email from a friend, from a client this morning, that Mother Nature is skipping summer this year. I hope not. I hope it's not skipping, and hope we do have summer. What's one thing that you're looking forward to with you and your family this summer? What's one fun thing that you're looking forward to?
Yeah, you know what? I definitely echo the comments around the weather. As you can see, it's still fairly gloomy outside here. I'm still
Hmm.
waiting for the sun to hit my body sometime this year. I haven't
Yeah.
quite felt it yet. But yeah, a couple of things. I mean, the World Cup is just right around the
Oh, cool.
corner. I love soccer or football for the hardcore fans out there. I'm
All
a big
right.
Messi guy. It's World Cup's coming to Toronto basically within the next month, so hopefully I'll be able to catch some of that action. And then it is patio season, so if it does warm up, I do want to meet up with a couple of friends, families here and there, and maybe in the back half of the year. The wifey and I were planning maybe an Asia trip, potentially Japan. So we'll see how all that
Oh,
kind of
wow.
plays out. So that's probably what's on deck for us. What about you there, Karim?
Yeah, so my summer is not going to be as much fun as yours, but me, I'm looking forward to the World Cup as well, like yourself. And you and I got to get together to watch some games, together. I don't know if I'm going to be able to see anything live unless I sell my house or mortgage my house to buy tickets. But I, like you, am a huge soccer fan. Our family is soccer, hockey, and tennis fans. So soccer is coming. That's like, Christmas. in our house. I'm looking forward to the same thing. And one of my sons is also a big Messi fan, so he's going to be watching. Messi 724. Which my team. I growing up watching Brazil and the Samba boys play. So my team would even though I don't think Brazil is gonna is got a chance. So my team would be Brazil. Who's your team be? Who do you think? I'll give you my heart and my head. What's your heart and head said? Who do you think is going to win?
My heart would say that I would want Argentina. I feel like this could be a France year, though.
Yeah. So my heart is divided between Brazil and Argentina. So I'd be happy either one, but my brain says Spain.
Spain, okay, there you have
Yeah,
it.
my brain says Spain's got a young team and some really really great players. So it'd be interesting to see but it definitely be an exciting World Cup that we are looking forward to. I think it's coming. We got another month to go or so.
Yeah, yeah, 100%.
So
I think it is another month, and I have a solution to our ticket problems or the cost of tickets. So yeah,
tell
tickets
me,
are
I'm all
prices are
ears.
through the roof, but condo prices are a little bit softer here in Toronto these days. So what we gotta do is that we gotta find one of those empty condos. We'll rent it out, and you and I we're gonna get some high spec binoculars, and we'll just peek into BMO Stadium.
I'm good. I'm good with that, Richard. Great idea. Imagine what we will save, right? Imagine what we will save. So no, Richard, thank you. Thank you for joining me in this episode of Deeper Dive. Thank you to you and your team for doing this great research. I think is a very important topic, inflation, what inflation impact it has on one's portfolio and investing. So, no, wonderful. Thank you for joining me today. Thank you for your team for doing this great research into this very important topic. I really appreciate it. To all the viewers out there, if you're already working with a portfolio management team like ours, then I'm 90% sure that your portfolio and this topic is being addressed right now, and the impact inflation has on you. However, if you're not entirely sure how your portfolio is positioned against inflation, and if you like a second opinion, please don't hesitate. Feel free to call my office. You can reach us at 416-956-8888, 416-956-8888, or you can email me at karim.visram@rbc.com. Again, karim.visram@rbc.com, and I'll be glad to have a conversation with you. Richard, thank you again for joining me. I really appreciate your time, your expertise. Please convey my appreciation to your whole team for this great work. Again, to everyone, all the viewers, I hope this conversation has been useful to you and practical. Please feel free to forward this video to anyone in your network that you may feel that will benefit from this. I really appreciate. And lastly, I appreciate any feedback you may have on any future topics that you'd like to hear more about. Richard, thank you again. Have a wonderful rest of the day, and I look forward to working with you in the future.
Sounds good. Thanks, Karim. Thanks
Okay.
for having me.
You're welcome. Take care.